Welcome to the Cycle Framework Insights podcast with Chief Strategist Bryan Jordan. Hello, this is Miriam Rush from the CFI podcast, and today we are talking about two very big picture topics, monetary policy and fiscal policy. I am joined, as always, by our brilliant Bryan Jordan to compare and contrast these policies, especially their differing impacts on the economy. Bryan, maybe we can start by highlighting the importance of this topic.
Yeah, it's a very important topic. This topic is the perfect example of the different fundamental factors and how those fundamental factors can influence the economy differently. Fiscal policy and monetary policy are both very important, but they influence the economy differently. Some fundamental drivers have bigger impacts than others, of course. Some are associated with longer lags than others. And some, as is the case here, are more structural than others or more cyclical than others. So this is a perfect example of that, how different fundamentals can influence the economy differently. More to the point and more pertinent for the current situation, this debate, this monetary versus fiscal policy debate, is very much the debate of the moment in the economy. It is the hard versus soft landing debate because we have a real split here between monetary and fiscal policy. Fiscal policy is very supportive of the economy right now, very accommodative. The budget deficit is nearly 6% of GDP. That's a very big budget deficit in a period of economic expansion, and it reflects a supportive fiscal policy stance. At the same time, monetary policy is by many measures restrictive. The Fed aggressively raised rates in 2022 and 2023. The Fed's benchmark rate is now a range of 5.25 to 5.5%. That's above benchmark long-term interest rates. It's above the inflation rate, both the overall inflation rate and the core inflation rate. So those are signs that monetary policy is restrictive. We have supportive fiscal policy, restrictive monetary policy. Which one of them is going to win out? Again, that's the big debate now, the hard versus soft landing debate. And a lot of that comes down to monetary versus fiscal policy.
Okay, fantastic. And just to be clear and to make sure that we're on the same page, can you define the difference between monetary policy and fiscal policy?
Well, there are a lot of similarities. At their heart, they're both attempts to influence the economy. Monetary policy are those steps taken by a central bank to affect the supply and demand for money, with the intent, of course, of impacting the real economy. And a central bank will typically do that through interest rates. Fiscal policy are actions taken by a government to influence the economy, and those actions are typically on the tax side and on the spending side. So both monetary and fiscal policy are attempting to influence GDP growth. They're attempting to influence the labor market. They're attempting to influence the inflation rate, but they're doing it through different channels.
Got it. So it seems that these policies have quite a bit in common.
That's true. They're both attempts to influence the economy, and to that end, they often do move together. So we tend to see that both monetary and fiscal policy are counter-cyclical. So when the economy is in a recession, for example, both monetary and fiscal policy tend to be expansionary, tend to be supportive. When the economy is in an expansion, when the economy is growing at a healthy clip, well, then we tend to see more restrictive monetary policies. We tend to see more restrictive fiscal policies. So they're both attempts to influence the economy, and they both tend to be counter-cyclical. Supporting the economy during bad times, taking a more restrictive stance during good times.
Got it. Got it. So then let's drill down and get to the heart of this. So what are the key differences?
So there are many key differences. One is that monetary policy is much more nimble than fiscal policy. So Fiscal policy is not so easy to engineer because you need a consensus to produce fiscal policy, a broad consensus. We need 218 votes in the House of Representatives. We need 51 votes in the US Senate, and we need the President of the United States to sign off. That's not always easy to get those three aligned. We often have split government. That makes it very difficult. In fact, if we go back to the early 1980s, over the last 40 years or so, we've only had 12 years out of the last 43 years in which we've had single party government, in which the same party has controlled the White House, the House of Representatives, and the US Senate. So we've seen some major fiscal policy proposals make it through Congress only to get vetoed by the president, for example. 1992, we had a major tax bill that passed both the House and Senate, vetoed by President Bush, the first President Bush in 1992. Just a few years later, we had a major budget deal, including some tax cuts passed by both the House and Senate. This was in 1995, vetoed by President Clinton at that time. So very difficult to get the White House, the Senate, and the House all to agree. In contrast, monetary policy only needs a majority of voters on the FOMC. There are 19 members of the Federal Open Market Committee. Every year there are 12 voters on the Federal Open Market Committee. So you need 7 votes to enact monetary policy change. Some would argue you really only need 1 vote, reflecting the importance and the power of the Fed chair. The Fed chair has not been on the losing end of a vote since the mid-1980s at an FOMC meeting. So it's generally the case that if the Fed chair wants to do something, it gets done. So you need 7 votes, but in reality, we often just need 1 person on the FOMC, the Fed chair, to enact major monetary policy change. And we can see these differences in the trends over time. So if we go back just over the last 30 years or so and look at tax policy, since 1993, the top income tax rate in the US has been in a very narrow range between 35 and 40%. A few times it's gone up a little bit, a few times it's gone down a little bit, but it stayed in this very narrow range over the last 30 plus years of 35 to 40%. Contrast that with monetary policy, contrast that with the federal funds target over the same time period. In that same time frame, going back to the early 1990s, we've gone from an 8%, more than 8% Fed funds target, down to 3%, then up to 6.5%, down to 0%, up to 2.5%, back down to 0%, and now up to 5.5%. So you tend to see a lot more movement in monetary policy. But the big difference, the real difference, is the impact that these policies have on the economy. As we mentioned, both monetary and fiscal policies are attempts to influence the economy, but they do it in different ways. They do it through different channels, and the impacts are different. Monetary policy is much more cyclical, much more within cycle, much more of the moment, has much more short to intermediate term effects. Fiscal policy is much more structural in nature, much more long-term in nature, has much more long-term effect. And so, in other words, fiscal policy affects the allocation of resources. It affects productivity. It affects the efficiency in the economy. So, for example, if we look at tax policy, higher tax rates produce a disincentive to spend and invest. And so we tend to see, we do see deadweight losses in these cases when tax rates are moved higher. And we see the potential long-term economic growth rate move down accordingly. In contrast, monetary policy is much more cyclical, has much more short-term impacts. So in the long run, monetary policy, in theory, doesn't have much of an impact. Monetary policy is neutral in the long term because money is neutral in the long term. If the Fed lowers interest rates to increase the supply of money in the economy. Well, that increase in the supply of money increases the price of everything, theoretically. Wages go up, prices go up. And so maybe you're paying 20% more for goods and services, but your wages are 20% higher. So in real terms, you're no better or worse off. Now, in the short run, it takes time for wages and prices to adjust. There are rigidities, there's stickiness in wages and prices. And so the Fed changes monetary policy, the Fed changes the supply of money in the economy. Wages and prices don't adjust immediately. So you do get these real changes in the short run. And so the Fed increases the money supply, the economy picks up. The Fed decreases the money supply, the economy slows down in the short run. Those effects even out in the long run. So our fiscal policy has long run impacts, not so many impacts in the short run. Monetary policy has short run impacts, not so many impacts in the long run. Now, these definitions aren't absolute. We have seen cases where fiscal policy has had some short run impacts. In fact, we've seen that very recently with some of the fiscal stimulus in the wake of the COVID recession in 2020. The stimulus checks that went out in early 2021, for example, fueled an 11% month over month increase in retail sales in March of 2021. Now, 11% would be a very good year for retail sales. Typically, if we see a 5 or 6% year for retail sales, that's a healthy year. We had 11% in 1 month when those $1,400 stimulus checks went out in early 2021. Obviously, there was some spillover. There were some short-term effects from fiscal policy stimulus. But in general, fiscal policy acts by affecting the efficiency of the economy, the productivity of the economy, capital formation, the long-term potential economic growth rate. It has long-run impacts. Monetary policy, much more short to intermediate term impacts. Fiscal policy structural, monetary policy cyclical.
Wow, that's very helpful. But let's come full circle and really tie this all together to answer the question that's likely most pressing on our listeners' minds, and that is, how can we expect the economy to respond in the months ahead, given the split between restrictive monetary policy and accommodative fiscal policy?
Well, again, this is the debate of the moment. If you believe that fiscal policy is dominant, fiscal policy dominates monetary policy and is the most important policy, well, then you have to believe the economy is going to continue to grow and grow at a pretty healthy rate in the months and quarters ahead. As we mentioned at the outset, fiscal policy is accommodative right now. Fiscal policy is supportive. We have a 6% deficit to GDP ratio. That's a very high deficit to GDP ratio, especially for a period of economic expansion. It's a reflection of healthy, supportive fiscal policy. In contrast, monetary policy, again, very restrictive. Even Jay Powell, the chair of the Fed, says that monetary policy is well in restrictive territory, with the Fed funds target at 5.25 to 5%, above the long-term benchmark U.S. Treasury yield, above the overall inflation rate, above the core inflation rate. So if you believe that monetary policy dominates fiscal policy, you have to believe that we're going to see a slowdown in the economy in the months and quarters ahead. Based on the previous question and answer, I think our listeners can see where we're going with this. Monetary policy is the cyclical policy. Monetary policy is the policy that has the short to intermediate term impacts. And we can see cases in the past where monetary policy has won out over fiscal policy. Take the early 1980s, for example. This was the era of double-digit inflation. This was the era when the Paul Volcker Fed pushed the Fed funds target up to 20%, a record high of 20%. Very restrictive monetary policy. It was also a period of supportive fiscal policy. In the summer of 1981, the U.S. government passed the largest tax cut in history, the largest tax cut in U.S. history. Very supportive fiscal policy at that time. Very shortly after that tax cut was passed, the economy fell into a recession. And in fact, it was a very deep and long recession. This was the second dip of the double dip recession of the early 1980s. It lasted for 16 months. We didn't come out of it until very late 1982. And so it was monetary policy that dominated in this case. It was monetary policy that carried the day. We had restrictive monetary policy, supportive fiscal policy, and we went into recession very shortly thereafter. Now, that doesn't mean that fiscal policy wasn't effective. Again, these fiscal effects are long run effects, and I would argue that that massive tax cut in the early 1980s very much helped to set the stage for the strong economic growth we had in the 1980s and through the 1990s as well. Not the only impact, but a very big part of that story, of that narrative for the next couple of decades. Again, monetary policy having those short run to intermediate run impacts, fiscal policy, the longer run impacts. That was very much the case 40 years ago. And it's shaping up to be the case again today because we're already beginning to see those monetary policy impacts. Lending activity has slowed. This is exactly what you would expect in an environment of tighter monetary policy. Credit creation has slowed. Last year, we had relatively weak consumer credit growth. Commercial bank lending activity had its weakest year since 2011. A major slowdown from where it was in the prior couple of years when supportive monetary policy had boosted it significantly. So we're already beginning to see those impacts. Lending activity has slowed down. The labor market in fits and starts is slowing as well. We're coming off of a pretty strong jobs report for the month of May, but jobless claims are beginning to tick higher. Job openings are down significantly. Cyclical job growth has slowed significantly. So we're already seeing that cooling process in the real economy as well, even as fiscal policy remains so supportive. So these effects are beginning to play out again. They may be playing out very slowly in this case, but they're playing out again as they have in the past. So it's our view that monetary policy will win out again. We're already beginning to see those signs, and the months and quarters ahead will bring a continued slowing in the U.S. economy. Supportive fiscal policy may very well, over the long haul, help the U.S. economy. But for now, restrictive monetary policy should mean that the risks are more to the downside.
Wow, very insightful, Bryan, as usual. Thank you for always putting these topics into perspective and helping us make sense of them. And thank you to all of our listeners for tuning in. For more information on this and, of course, many other topics, make sure to head over to cycleframework.com. We would absolutely love for you to join our community. Thanks, and we will now catch you on our next episode.